If you're like many retirees, you've probably heard of Qualified Charitable Distributions, more commonly referred to as QCDs. But what you probably didn't realize is that these could actually save you tens, if not hundreds of thousands of dollars in taxes over the course of your retirement. And for the generous Christian retiree or the generous retiree in general, you could possibly save a tremendous amount of taxes due to some of the other tax ramifications of doing a QCD versus having this money come out as a taxable distribution. So in today's video, I'm going to walk through an example case study, and I'm going to show you exactly how it would look if somebody were to do a QCD versus if they were to take a normal IRA distribution. You'll probably be surprised by the difference in just how much it can save you in taxes. Now, as with all of these videos, keep in mind that your mileage may vary. It's very likely that your situation doesn't exactly match the case study, and the different income sources you have in retirement, the taxability of those income sources, all of those are going to play a factor in whether or not there's a greater benefit when it comes to doing a QCD versus not. And as I'll show you in the video, just simply avoiding increasing your modified adjusted gross income could potentially save you a tremendous amount of money by reducing the amount of your Social Security that gets pulled in to taxability. Hey, I'm David Dodd, founder of The Other 90 Financial, and I help Christians retire successfully and steward well. If you like this type of content, please hit the bell icon so that you get notified each time I put out a new video. As always, hit the like and subscribe and let us know what you think. And don't forget to check out the link in the description so you can get our free 2024 flowchart that'll guide you on understanding if you can or cannot make a qualified charitable distribution. So before I jump into the case study, I want to explain a little bit more about what the QCD is, but stick around and I'll show you the case study a little bit later in the video so that you can see an example of how this could possibly play out. So what exactly is a QCD? Well, a QCD is exactly what it sounds like. It's a qualified charitable distribution. So the first key to understand is the C and the D. It's a charitable distribution. So this is a distribution that is leaving your IRA and it's going to a charitable organization, a 501c3 specifically. It's never touching your hands. It's going from your IRA directly to a charity. So it's a charitable distribution. Now, the qualified part, it depends on your eligibility and, of course, assumes that you meet those eligibility requirements to get this preferred tax treatment. Now, this will not count if you send it directly to yourself, to a donor-advised fund, to a private foundation, or other non-qualifying organizations as deemed by the IRS. And so we're extremely clear, the tax benefit here is that by taking the money from the IRA and making a QCD directly to a charitable organization, a 501c3, is that we don't have to include this income in our taxable income at all. And so instead of having this normally come to us and then be taxed at our ordinary income tax rates, we're able to send it and have it not even factor into the calculation. It's not a deduction, it's not an above-the-line deduction, it's just simply not reported on our tax return, which means there's no possibility of it increasing our adjusted gross income or our AGI or our modified adjusted gross income or MAGI. And so since it doesn't do this, we get the added tax benefit of it possibly helping us qualify for lower taxability on other income sources, such as our Social Security income. In addition, it also gives taxpayers who don't normally get to itemize and get a tax deduction for their general charitable giving or their tithes to their local church. This gives the individual taxpayers an opportunity to make a QCD directly from their IRA and effectively, although not technically, get a deduction on those charitable contributions. So now that we have a grasp on what a QCD is and why it might be beneficial, who can actually do a QCD? Well, the first criteria is in order to do a QCD from an IRA, we of course have to have an IRA. And so you or your spouse need to have an IRA in your own name, or perhaps you may also have inherited IRAs. As long as you have an IRA of some type, then you may be eligible to do a QCD. The second criteria is that you have to be age 70 and a half. I know there's a lot of confusion around this age because many people think in order to do QCDs that you have to be RMD age, and they tend to tie these two things together because in the past those two ages were the same. However, as legislation has continued to be passed, what we've seen is the RMD age has actually gotten pushed back. However, QCD age has not. And so QCD age as of 2024, when I'm actually making this video, is still 70 and a half. I would also be doing you a major disservice if I didn't clarify that when I say you have to be age 70 and a half, I want it to be crystal clear. You have to have already turned age 70 and a half at the time of the QCD. This isn't something that you can just do in the year that you turn age 70 and a half, but you must already actually be age 70 and a half. So that's the who can do a QCD. Now, there's also additional eligibility rules. So in order for it to qualify as a QCD, you'll have to actually make sure that you're abiding by whatever the current year's limits are for QCDs. For quite some time, that was capped at $100,000 per taxpayer in QCDs per year. However, due to some new tax legislation and reform that came via the Secure Act 2.0, they actually changed that so that it would become indexed to inflation beginning in 2024. So this year that I'm filming this in 2024, the current amount that you can make per taxpayer is $105,000 in QCDs from your IRA to a qualified 501c3 organization without having any income tax ramification from that QCD. In order for it to be eligible for that, it has to be at or below that limit. If you were to give $120,000 per taxpayer, for example, then you would be $15,000 over the $105,000 limit, and that $15,000 of excess above what was allowed under this eligibility requirement for QCDs would actually be taxed as ordinary income tax on your tax return. There are actually quite a few other things that changed as a result of the Secure Act 2.0 legislation, but that's probably for another video. One notable thing worth mentioning, though, is that if you're making pre-tax deductible IRA contributions after age 70 and a half, this will interrupt the ability to do QCDs without some complications. And so I won't launch into the details, but basically they have a QCD anti-abuse rule that prevents you from making deductible IRA contributions, getting a deduction, and then also making a QCD with those same dollars, effectively double dipping. And so just be wary of that if you're still saving into these pre-tax deductible IRAs after age 70 and a half when you're thinking about doing QCD. So assuming that you meet the criteria, you're eligible, you have extra money in your IRAs that you want to give away, and that you're already generous, keep in mind, you don't want to do this for a tax benefit. It never makes sense to give away money to get any sort of tax benefit, because you would effectively be giving away perhaps $1 to save 25 cents in taxes, and that's never a good trade. But if you're already generous and you meet all of the rules, then you may be asking yourself, how do I actually make a QCD? How do I execute this to make sure that I don't mess it up anywhere along the way and that it qualifies for the preferential tax treatment? There are really only 4 high-level steps that are necessary to make sure that your QCD is eligible and qualifies for income tax-free treatment. Number 1, you have to determine that you're actually eligible to do a QCD. Seems obvious, but just check the eligibility criteria and before you proceed with doing anything, make sure that you actually meet all of those. Number 2 is to confirm that the charity you want to send the QCD to does actually qualify under the Internal Revenue Code. And so I'll post that code on the screen here. You'll just want to double check that before you make your QCD. Number 3 is that we want to make a direct, and that's direct in all caps. I want to emphasize we make a direct transfer, and that's from your custodian where your IRA is held directly to the qualified charitable organization. And so we don't want this getting muddied up in the middle. We don't want it coming to you. We want this money to go straight from your IRA, transfer directly to the charitable organization for the cleanest possible break and to avoid any potential appearance of it being a normal distribution, in which case it would be taxable as ordinary income. And number 4 is going to be circumstantial, but if you're trying to do a QCD specifically to avoid having to take an RMD, then you'll want to make sure that you do the QCD first. It's very important that if that's your intended goal, is to actually replace or to absorb some portion of your RMD by making this QCD, then you have to do the QCD first. This is because the first dollars out are deemed by the IRS as having been your RMD, whether that's what you intended or not. I want to double back for just a second to number 3 though. Number 3 needs a little bit more explanation. Now, I said that you want that money to go directly from the IRA custodian to the charity, so we don't want it muddied in the middle. However, it is commonplace and very likely that they'll want to send the check to you first and then have you mail it to the charity. There could also be check writing options where you're writing a check from your IRA, which would still meet the eligibility requirements. And so it's a little bit more nuanced, but the key is just be aware of how you're making it and make sure that the money's not landing in your pocket or in your hand, rather that you are still making or directing a QCD from your IRA to the charity. And this is also a good reason and a good time to let you know that you should start your QCDs early. If you want to make sure that it gets done and that it's actually deposited and received by the charity by 12/31, then we need to make sure that we start this process early enough that the check can actually be processed, remitted, received, then mailed and received by the charity, and then deposited so that we can actually complete this QCD by 12/31 in order to have it count for the current year. What we don't want is to start a QCD too late in the year and have it half-baked when we hit the 12/31 deadline, thereby actually being treated as taxable income and not getting treated as a QCD as you intended. Now, while I could make this a much longer video and opine on all of the technicalities, caveats, nuances around the rules of doing QCDs and when they do and don't make sense, I thought it would be more practical at this time to transition to a case study and show you in my tax planning software what a fairly average situation might look like if they were to do a QCD versus doing just a normal IRA distribution and then doing their giving after the fact. All right, so let's take a look at Jim and Jane Sampleton. In this case, what we have is we have a fairly typical couple where they have no wages, they're retired. They've got $25,000 in regular IRA distributions. That's money actually coming to them. They've also got $20,000 here in QCD. So this is money that they're actually going to transfer from the IRA directly to the 501c3 or their church or wherever they're making the QCD to. They also have $1,000 a month or $12,000 a year in taxable pensions or annuity income. And then they've got $54,000 in gross Social Security income. And so this is going to be split evenly between the two of them. And I'll click in here so that you can see we've got $36,000 for taxpayer one. This is the primary income earner here who had the higher benefit. And then we're just assuming, to make things really simple, 50% of that for the spouse. Now, it's not that simple. I don't want you to leave here thinking that's how it always works. It's very often not the case that you're going to get exactly half. You can get up to 50% of your spousal benefit as the lower earner, but that's only if you meet certain conditions and we're filing appropriately. So perhaps I'll make a video on that another day. But we've got full benefit of $3,000 a month on one end and $1,500 a month for the spouse. Total $54,000 per year. We're going to have a standard deduction of $32,300, and as you continue down, you can see just kind of how this all plays out. So what's the key that I want you to take away from this? Well, I want you to see that with the QCD, they have total income of about $60,000, total taxable income of $27,700, and a total tax bill of just under $3,000. They're in the marginal tax rate of 12%. Their average rate is only 4.8%. If we look at this calculator here, what you can see is, if you look where my cursor is, that's where we are right now. Every additional dollar that they realize in income from their IRA distributions is actually going to result in pulling more Social Security into taxation. And this is often referred to as the Social Security tax torpedo. And so $1 of taxable income is causing another 85 cents of Social Security to become taxable. Now, if you look at this chart, what you can see very clearly is that By making the QCD, basically we're reducing from $97,000 to $60,000 in income, and so the same thing for our adjusted gross income, and that is saving us nearly $4,000 in taxes, a shade over $4,000. If you factor in state taxes, it's actually more like $5,000. Now, if we come over here and look at the example without doing the QCD, what you'll see is a little bit of a different story. So if they were to just take that $20,000 out of the IRA as a normal distribution instead of as a QCD, what you would see is that they would actually have $97,000 instead of $60,000, and then they would end up with $64,700 in taxable income. And so their total tax bill is at $7,300 as compared to about $3,000. And so that's where you get that $4,000 difference. What it ignores, though, is if we look at the difference between these two, and I've ran for the state of Indiana just kind of a rough calculation, we also have a difference of not quite $1,000 on state taxes. And so what we see is that it's really saving you about $5,000 in this case to just make a QCD versus take the money out first. And so for anybody who is in this spot where they're actually phasing in Social Security into taxability, it could be a really smart idea to look at QCDs and make sure they make sense for your overall tax plan. But if they do, they can be a really useful tool in reducing the amount of taxes you pay and maximizing the amount of giving you can do after tax. Well, hopefully seeing that case study that they could have saved nearly $5,000 in taxes by simply making a QCD versus making a normal IRA distribution, I hope that's enlightening to you. There are many other areas of tax planning and many other areas of financial planning that can add a lot of value like this, but most people just don't know about it. Many advisors don't care to take the time to educate, or they may not know themselves. And so a lot of times these opportunities go overlooked and they get missed completely. For me, however, I think it's really important to educate the public like yourself and to help my clients make sure they're taking every opportunity that they can to reduce their taxes and to maximize their giving. Especially as Christians, I think it's really helpful to think about this as an aspect of our stewardship, a way that we can honor God by being attentive to the different tax strategies that we can use to maximize our giving. It's not all just about amassing wealth for ourselves and to keep all of this money for ourselves, but there are strategies that can allow us to give more and reduce the amount we give to the government, which I think makes most people pretty happy. If you clicked on this video hoping to get some sort of direct answer of you should or shouldn't do a QCD, I hope that you're severely let down. Each QCD needs to be analyzed on its own in the context of a comprehensive financial plan. There's really no way for me to know if a QCD is a good or a bad idea for you because I don't know what you're trying to accomplish, I don't know your goals, and all of those are going to play into whether or not QCDs make sense for your situation, for the strategies you've implemented or not. Now, don't get me wrong, giving via QCDs is a really good strategy, but it's not the only giving strategy that's out there. There are a couple other really good ones, and hopefully I'll put out some videos here soon on those, like donating appreciated securities or stocks, or perhaps bunching your charitable deductions into every other or every few years. Both of those strategies could be really good tools for your situation as well, and which one's going to be the best is really going to depend, like I said, on the context of your overall plan and what you're trying to accomplish. So I hope that's helpful. It's not the most exhaustive on the technical side, but hopefully it's practical and gives you something to walk away with and think about, and then possibly bring up to your tax advisors or your financial advisors so that you can actually look at instituting something like this in your plan and hopefully realize some tax savings, not just so that you have more money, but so that you can share, that you can give more to the causes you care about. And if all of this is just, really confusing and overwhelming, and you want somebody to help you, but you don't have a tax person in your corner, or maybe you don't have an investment advisor or financial planner who talks to you about these sorts of things, then feel free to click the link in the description, and I'd be more than happy to set up an intro call and see if what we do, if our expertise matches what you're looking for, and perhaps we could help you lower your taxes, increase your giving, and overall just improve your financial plan. Thank you for watching this video. If you find this type of content helpful, please hit like and subscribe so that I can continue to get this information out to more people just like yourself. My hope is that this will help people give more and save on taxes. I think that's a goal that everybody can get behind. If you have any questions about the topic, QCDs in general, please leave them below the video and I'll answer as many of them as I can. Thanks again, and I hope you have a good day.